Hey guys, welcome back to the channel. Really appreciate you guys being here. We've been talking about taxes and how it affects a couple different things. Well, one of the big things we like to talk about around here is, retirement, funding your retirement. Well, I want to talk about how capital gains tax works on pension funds, right? The good, the bad, the ugly, all that in between, right? Because, first off, pension funds are a type of plan where employers, employees, or a combination of both pay into a fund to provide retirement benefits to employees. Right now, this pension money is invested in a bunch of different, financial securities over many years. And then, the money grows and is paid to employees to provide them with an income during their retirement, right? So we kind of want to dive into this, and I don't want to get super deep into it, but we're gonna get enough into it where you get a decent grasp of what's going on, right? So first, let's start off with pension funds and taxes, right? So pension funds build up assets over time, right? And they're going to provide individual employees with benefits after they retire. Each employee usually has a choice to accept a lump sum payment from the pension at the time of their retirement, or to receive monthly income payments, right? Now, depending on your situation, one might be better than the other. Capital gains taxes due on realized profit from the sale of certain types of assets, right? Think stocks, bonds, mutual funds, and ETFs. Now, capital gains, right? The tax is it's going to be broken out into two types. So we got short-term capital gains tax and long-term capital gains tax, right? We went over this before, but let's touch on it real quickly. Short-term capital gains, that's going to refer to realized profits from the sale of securities that were bought and sold in less than 1 year, right? So long-term capital gains tax refers to realized profits from the sale of securities bought and sold longer than 1 year, right? So the tax rates on these gains are different. So stocks, bonds, and funds, the long-term capital gains tax rate is going to be either 0%, 15%, or 20%. And of course, that's going to depend on, the income level, right? So the short-term capital gains tax is the same as the individuals or entities, however your ordinary income rate, right? So the since a pension fund normally invests in these types of assets, you would expect that they need to pay these taxes. However, pension funds are exempt from paying capital gains tax. This is going to create unique opportunities for asset growth within pension funds, right? Okay, well then let's talk about how a pension fund benefits from not paying capital gains tax. Well, typically, pension funds don't have to pay capital gains tax, which is going to allow the assets in the fund to grow faster, sometimes considerably faster. So consider a pension fund, say, with a starting balance of 10 million, and it grows at 10% each year. And let's say it does this for 5 years, and it's paying zero capital gains tax. So assume that at the end of each year, the entire portfolio is rebalanced and all investments are sold and replaced with different ones. At the end of the 5 years, this fund's going to grow to a little over 16 million, and it pays no capital gains tax in the process. So we basically got $6 million, right? Now, let's do another one. Imagine a hypothetical second scenario, right? Let's do another one. Let's say this time the pension fund has to pay taxes, right? Okay. So a fund with an initial balance of 10 million and growing at 10% each year for 5 years would be worth 15, a little over 15 million. Yeah, a little over 15 million, right? And of course, fully rebalanced at the end of each year, right? Because the capital gain taxes were 15%. However, the fund would have to pay almost 900,000 in total capital gains taxes, right? So, because the pension fund in the first scenario does not have to pay the capital gains taxes, it saves that almost $900,000 in this scenario, right? Basically $1 million, right? And since that money remains in the pension fund, it's gonna grow as well, right? Adding another almost $200,000 of capital to the pension balance. Okay, well, what about taxes on employee distributions? Okay, well, while the pension fund itself, while it doesn't have to pay capital gains taxes, the distributions to the employees will be taxed at the beneficiary's income rate, right? So if an employee uses, his or her pension fund distributions to make his or her own investments, that money is going to be subject to capital gains taxes in, the year that any realized gains occur. However, since the pension fund is tax exempt prior to distribution, it results in a larger retirement benefit for, that employee, right? So, that's something to think about, whether you want to do distribution, like a monthly distribution or like bi-weekly, or if you want to take that lump sum and get, a big portion up front, pay your taxes early, and then use that to, pay your bills off or invest it in something, whatever it is that, you want to do. So, a special consideration, something I want you to think about, because, while pension funds are not, while they're not required to pay capital gains taxes, the corporations that supply the pension funds, they pay corporate taxes, right? So this amount may have some effect on the amount that the companies pay into their employees' pensions funds, which that might have an effect on investor balances, right? So again, just something to think about, when you're thinking about what you want to do, where you want to put your money, you know, and just think about what it is that you need, right? Because what you need is going to be different than what someone else needs, right? So don't think one scenario fits all, right? Really take into consideration which going to work out better for you, right? A lot of times, if you retire earlier, right, you have to take in consideration. Okay, if I take this lump sum, what do I do with it? Do the pension payments, distributions, do they average out to be more in the long run, right? So just again, whatever works for you, do your due diligence, right? I really hope you guys enjoyed this video. If you're not already subscribed to the channel, I really appreciate it if you do. Go ahead and thumbs up this video, share it with some friends, and so I'll see you guys in the next video. Y'all be safe.